$400 a month or $25 a month. Same $500,000 of protection for your family. One of these makes your agent very, very rich. Same coverage, 18 times the price on an annual basis. A commission check bigger than most people's mortgage payment, and a savings account that pays you almost nothing for the first 2 years. This is term versus whole life insurance, and the difference can cost you $6,000 a year. And here's the wild part. Most people shopping for life insurance have no idea this gap even exists. So let's follow the money. Every single dollar of it. Quick definitions, zero jargon term life insurance is coverage you rent for a set window, like 20 or 30 years. You pay a small premium, and if you die during that window, your family gets the death benefit. That's just the check the policy pays out. Whole life insurance lasts your entire life, and it bolts on a savings account called cash value, money that slowly builds inside the policy. Same goal. Very, very different price tag. Real numbers, a healthy 30-year-old buying a $500,000 20-year term policy pays about $25 a month, roughly $300 a year. Women often pay closer to $23. Now take that exact same person, same $500,000 of coverage, and quote it as whole life, $400 to $450 a month. That's up to $5,400 a year. Do the subtraction. At 30, the gap is about $5,100 a year, and it gets worse as you get older. At 40, term costs around $40 a month, but whole life jumps to $550 a month. That's a $6,100 difference every single year. That's the $6,000 mistake. And whatever you do, don't wait. A 40-year-old man pays 54% more for that same term policy than a 30-year-old at 50. It costs 146% more than it did at 40. Every birthday makes both options pricier, but it makes whole life explode. Here's the tragic part. According to LIMRA, about 100 million Americans say they need life insurance or more of it, and the number one reason they don't buy. They think term costs 3 to 5 times what it actually does. Meanwhile, searches for term life insurance are up 54% in 2 years. People are waking up. Now the famous move, buy term and invest the difference. Take that $5,100 a year you saved, put it in a boring index fund earning 8%, and in 30 years you're sitting on roughly $575,000. That's the math the whole life pitch hopes you never do. So where does your extra money actually go? So here's the question. Why does whole life cost 10 to 15 times more for the same death benefit? Part of it is real. Lifelong coverage costs more to provide, but a huge chunk of that premium has nothing to do with protecting your family. Let's break it down. First, commissions. When an agent sells you a whole life policy, they typically earn 50 to 100% of your entire first year premium. Paying $5,000 a year, your agent may pocket $2,500 to $5,000 the moment you sign. Term pays commissions too, but it's a percentage of a $300 premium. We're talking lunch money, not a used car. Now, this doesn't make agents villains. Most genuinely believe in what they sell. But put yourself in their shoes. Recommend term and earn coffee money, or recommend whole life and earn thousands. That incentive shapes the advice you hear, whether anyone admits it or not. And it explains why the sales pitch is always about the savings feature, about that savings account. In the first 1 to 2 years of a whole life policy, your cash value is basically zero. Pay in $12,000, try to walk away, and you might get back nothing. The surrender value is near zero early on and long term. The effective return on cash value typically works out to about 1.5% to 3.5%. Your high-yield savings account might beat that. So before you sign anything, ask one question. What is your commission on this policy? And what would it be if I bought term? An honest agent answers both. A dodgy one changes the subject. Now, to be completely fair, sometimes whole life genuinely is the right call. Let's talk about when. Here's the honest part. Whole life isn't a scam. It's a tool. It makes sense if your estate is big enough to face estate taxes and your heirs need cash to pay them. If you have a child with special needs who'll need care after you're gone, lifelong coverage matters there. If you're a high earner who's already maxed out every retirement account and wants another tax-advantaged bucket, or if all you need is a small final expense policy to cover burial costs. One warning while we're here, if someone pitches you an indexed universal life policy, an IUL, be extra careful. It's a cousin of whole life where your cash value tracks a stock index, and the pitch sounds magical. Market gains with no losses. The reality is capped upside, layers of fees and illustrations that almost never match real-world results. It's one of the most aggressively oversold products in insurance, same commission engine, fancier packaging, but for most families. You need the most protection during a specific window, while the kids are young, while the mortgage is big, while your income is everything. That window is exactly what term insurance was built for. Massive coverage, tiny price, gone when you don't need it anymore. So how do you decide? 3 questions. Question 1, do you need coverage for a specific window or literally forever? If your answer is until the kids are grown and the mortgage is dead, that's a window. That's term. If your answer is genuinely forever, like the special needs or estate situations, now whole life enters the chat. Be honest about which one you actually are. Question 2, are you already maxing the better options first? Your 401k up to the employer match? That's free money. A Roth IRA, an emergency fund. If you haven't filled those buckets, committing $500 a month to a policy earning maybe 3% is skipping the line. Fill the good buckets first. Question 3, and this one's brutal. Can you afford this premium for 20 plus years through job losses and recessions and surprise babies? Because here's what happens when people can't. Roughly 1 in 10 whole life policies lapses in the very first year, and about 10% more die in year 2. Lapse early and you lose the coverage and the cash value. A large share of whole life policies never survive long enough for that savings account to matter. The insurance company keeps it all. 3 takeaways. Number 1, get quotes for both same death benefit, term and whole life, and make the agent show you the commission on each. Number 2, calculate the difference, and if you choose term, actually invest it. Automatically every month, the whole strategy dies if the difference just evaporates into takeout. Number 3, check what life insurance you already get through work and recheck your coverage every 3 to 5 years. New baby, new house, new salary means new math. The one-line rule. Buy insurance for protection, use investments for wealth, and be suspicious of any product that promises to do both. It usually does neither well. If this saved you from a $6,000 mistake, hit subscribe. I'm InsurNerd, new videos every Monday, Wednesday, and Friday, explaining insurance without the jargon. See you next time. This video is for educational purposes only and does not constitute financial or insurance advice. Always consult with a licensed insurance professional before making decisions about your coverage.